Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He is a former Wall Street bond trader. He's a newsletter writer at Investment Research Dynamics and also gold fund manager. Dave Kranzler, thank you for joining me again.
Oh, thanks for having me back on, Jason. It's good to see your podcasts are back up and running.
Yeah, now that the new laptop is up and running and the bugs are worked out and I'm figuring things out, it's really fast and Zoom is actually working perfectly. You can hear me and the interview is not going to be lost. Unfortunately, lost a couple of interviews in the summer of 2020 and your last interview on here was one of them. So I apologize for that, but I wanted to get your insights about what's happening now, all this crazy speculative mania in the stock market, options trading, Robinhood app. You were around working on Wall Street as a bond fund trader and trading stocks during the technology bubble in 1998, 1999, and 2000. Is this very similar or is this actually much worse?
It's funny, a couple of weeks ago, the title to one of my short seller journals that I publish every week, I titled it Old Wine in a New Bottle. And I drew out comparisons between what's going on now in 1999 and what we're seeing with like the Reddit chat board and Wall Street bets and, you know, the options trading, et cetera. I mean, it's really not that much different than what was going on at the very tail end of the 1999, early 2000 tech and .com bubble. Back then, investors or retail guy, and it was the same thing where all of a sudden we've had a flood of uneducated retail investors who have they didn't even know what the stock market was all about until, the lockdown period. And all of a sudden, you get a trading app like Robinhood. Hey, come trade with us. There's no commissions. And so, you've had a massive influx of all of a sudden, I call them quote unquote newly minted retail trading experts. And the pumping and the promotion that goes on the, the Reddit chat boards, that's exactly what was going on at the end of 1999. All of a sudden you had a huge influx of retail day traders. Instead of Reddit, the one of the big chat boards was Raging Bull. I don't know if you remember Raging Bull. You might be too young, but Yahoo Finance had a very active retail chat board community, and it was just the same crap. I mean, people who had no idea what a financial statement would look like would, hear about some 4-letter .com symbol that was supposed to, go up 1,000 times in the next week, and all of a sudden everyone would pile into it, and then eventually everyone started trying to sell all at once, and like we've seen with GameStop. I mean, that thing peaked at 483. I think it was last week, maybe early last week, maybe late the week before. Now it's closed at 51 today. So this is gonna just like it did in 2000. Like I read a study that was done a couple years after the NASDAQ had crashed. I think it was around 86% from top to bottom. And something like 90 or 95% of all retail, quote unquote, day traders got wiped out by that sell-off, or basically market collapse is what it was. And I think you're going to see the same thing this time around.
I think there's even more unprofitable technology companies now than there was back then, because there's all these special purpose acquisition companies and all these technology companies. And then there's the cryptocurrencies as well, all these altcoins. Now, thankfully, I think the ICO scams, a lot of these pump and dump ICO scams are temporarily, a lot of them taken out. But have you seen any of these TikTok or Instagram videos where they're scantily clad women wearing bathing suits or lingerie, and it's pretty clear that they really don't know anything about the stocks? They're either reading a script or they bought a trading program that's overpriced, and they're bragging about making thousands of dollars a day, showing screenshots of their trading accounts. So either making thousands of dollars a day trading stock options or stocks or cryptos or a combination of these things, because stocks only go up apparently, and they just spent their stimmy check on just gambling on stock options or cryptos. It's unbelievable that they don't think about the risk. So they only see the reward And I think a lot of guys are watching these videos, younger adult males and that are at home not working. Maybe they got their stimulus check or something like that, or they're working online and they watch these videos of the women and they're just buying whatever the woman recommends now. I think that's pervasive.
Yeah, I don't know. I don't have time to track TikTok videos or Instagram, but to answer the second part of your question before, is it worse this time around? Well, the scale of it is many multiples larger than it was back then. And it's a function, it's 100% a function of the amount of money that's been printed by the Fed. So back then, Greenspan, when we had a series of rolling economic and financial system crises, both here and abroad. And every time there was some type of crisis, Greenspan would print money and monetize the problems, make them go away, quote unquote, go away. And the problems started getting bigger. And then you had the long-term capital collapse. And I mean, I was at Bankers Trust at the time trading junk bonds, and Bankers Trust was one of the big derivatives purveyors to long-term capital. And I remember, I mean, people were worried that, it was kind of the same thing that we heard in 2008 when the market collapsed. Oh no, long-term capital is a systemic problem, and the global financial system will collapse if we don't prop it up. So they went around and the biggest pimps for long-term capital, the biggest Wall Street pimps like Bankers Trust, had to pony up a ton of money to be part of the bailout. I mean, part of the difference is that now the Wall Street firms wouldn't have to pony up any of their own money, but the Fed also printed a boatload of money. And I think that's what really sort of kicked off the real final stage of the tech bubble back then. Because that was right before the dot-com bubble really started to take off. If you look at the NASDAQ, like, I think it was like between November 99 or early December 99 and when it peaked, which I think was March 2000, mid-March maybe. I mean, the NASDAQ doubled. So it doubled in like 3 months. And the other leg of that was, if you remember the Y2K situation, which turned out to be a complete non-event. Greenspan dumped a ton of money into the financial system. It was like in mid-December because, under the guise of, Y2K could bring down the planet. And in my opinion, it was really just a cover story for getting a lot more capital injected into the system that was highly unstable because of the bubble he had blown starting in the mid-90s. So, and we were seeing the same exact thing today, except the scale is many times larger. I mean, back then, the Fed's balance sheet was, I don't have the exact numbers. I know it was about 800 billion before they started printing money in 2008, and it had been kind of flat for a while. So, let's just say it was maybe 500 billion or 200 billion back then. And now you're looking at a Fed balance sheet that's what, 7.3 trillion. I mean, the numbers are just incredible. And I don't know one person who didn't fall off their chair laughing when Powell, at the last, the post FOMC meeting presser, he tried to look into the camera with a straight face and say what's going on in the stock market has no correlation to the amount of money the Fed has printed.
Yeah, and Janet Yellen's talking about a strong dollar, which is just ridiculous too.
That's just disingenuous. I mean, that's just jawboning, because the dollar was, starting to look like it's going to fall off a cliff.
And also this bond bubble is fueling the stock bubble, because all this cheap debt, the corporate bond bubble has exploded in size since the 2008 financial crisis. Share buybacks have fueled stocks, and all this cheap debt is sloshing around. We were talking before we started recording about, since March and April of 2020, when the Fed started issuing press releases, they were going to buy a lot of this garbage to stabilize, and I'm using air quotes, the credit markets. The amount of collateralized loan obligations, leveraged loans, junk bonds, corporate debt, it's just exploded again. And now it's going a new leg higher in January of 2021. We're at even more ridiculous. So that helps fuel the stock market bubble too, is all this cheap debt, because then the cycle of share buybacks to juice earnings higher, earnings per share, because the companies can't really grow because the real economy is nowhere near as good as it was in the 1999 technology bubble. That's the other major difference, excuse me, between the technology bubble back then and now, is that not only is there more currency and credit sloshing around, like you said, is that the real economy now is destroyed by politicians and bureaucrats. They won't allow small business to open. So at least there was a real economy back then with some small business. Now it's being totally destroyed by the government.
Yeah, that's absolutely right. I mean, there's a lot of comparisons, if you want to compare back then to now, all kinds of fiscal data where everything is just way worse now than it was back then. The total amount of debt, pull these numbers up. The total debt to GDP, so that's government, corporate, and household debt, is now 365%. The total amount of debt is 365% of GDP. Before the crisis started in March, it was 326%. So the current total amount of debt outstanding is 77.4 trillion. I mean, the media and analysts and commentators only focus on the amount of treasury debt outstanding, but if there's $27 trillion of treasury debt outstanding, there's another 50 trillion of local government, state, corporate, and household debt outstanding. So $620,000 of debt per household. At the height of the tech bubble back in '99, the amount of debt outstanding was $260,000 per household, and it was $475,000 per household at the peak of the housing bubble, back in 2007, 2008. So, I mean, the economic and financial system is just getting crushed with debt, and right now the only way the Fed can prevent interest rates from rising is to buy treasuries. They've bought something like 70% of all treasuries issued since October. They're doing what they can to keep a basically, a gerbil with barely a heartbeat, running on the gerbil wheel, and at some point even inject, printing money into the system like they have been doing. It's not going to work. In terms of the junk bond issuance, I mean, the generic junk bond yield index, if you want to use HYD or JNK, the yield on those ETFs is the tightest to treasuries in the history of the junk bond market. And that's another attribute that we're near a top in this insanity, because right before the market crash in '08, and just back in March, late February and March 2020, the yields, the spread of junk bonds to treasuries had also, pretty much narrowed to record lows. So, to me, what's going on in terms of, the junk bond market and the mania, that it doesn't get a lot of attention because it's not as exciting and sexy as stocks. But that mania is just another indicator that we're near a top.
Well, I would argue, Dave, that the junk bond market, this corporate bond bubble, is subsidizing or fueling the stock market, because all these corporations, they can't grow free cash flow. They can't create new products and services. Most of them can't. And the ratings agencies are also helping out, because the ratings agencies are not downgrading anywhere near the amount of companies that they should. There were hardly any downgrades, actually. People expected a lot of downgrades. I was covering this about a year ago during the pandemic as it was starting, and none of the downgrades materialized. And because there was no downgrades, because bond prices, they rallied very strongly, that signaled to the corporations, that signaled to Wall Street, time to start selling more bonds. It's time to start issuing more corporate debt. And of course, like you said, there is no income from treasuries and other government bonds. So then naturally people are desperate for income. They're going to start buying junk bonds then.
Yeah, no question about it. It was the same thing in 2007, 2008. The rating agencies, didn't change the ratings on all of the leveraged trusts, the bonds issued by the leveraged trusts, and they didn't, and by junk bond companies. And I mean, look, the rating agencies are a complete joke. Getting a rating on a bond it's basically, another form of marketing. It's about as useful as the good housekeeping seal. It means nothing. I mean, Moody's had Moody's had Enron rated at investment grade until about a month before it collapsed.
That is
I
pretty
mean,
bad.
and it's the same thing now. The rating agencies are basically paid by Wall Street and the corporate clients to not downgrade these things. I'm not saying they're direct payments, but that's essentially what it is.
And they're worried about losing their charter. So there's only, the three major ratings agencies. So if the government were to threaten them, they're going to back off, which is why the US federal government debt, after Egan Jones downgraded them, the other ratings agencies have backed off and haven't downgraded US federal government debt either.
No, I know it. I know it. There's a great scene in the movie The Big Short where I forget which parties it was, but they went in and they were talking to some ratings agency analyst, and they were giving her the third degree, and she was just like, look, it's out of my hands.
Yep, marching orders from the top.
But that scene illustrated what goes on with the rating agencies, and most people have no idea about that.
So I want to transition now to gold and silver, which you're an expert at. I've known you for a long time covering gold and silver markets. You've had many winning stock picks for junior mining stocks. But first, I want to talk about gold and silver demand and the dislocation between demand and paper price. So we're recording this interview on Wednesday, February 10th, 2021. Gold prices have rallied a little bit. They were briefly below 1,800 in the last week or so, and silver prices got smashed. Meanwhile, what we're seeing in reality for US physical silver demand and Sprott Physical Silver Trust, the demand is just enormous. I think the PSLV, the Sprott Physical Silver Trust, 10 million ounces of physical silver has come into the trust in under 3 weeks, an insane amount. It's over 100 million total ounces of physical silver in the trust for the first time in their history. So what do you think the demand picture is out of China, India for physical gold? And are there real shortages then for physical silver?
A large majority of people who are, kind of casual or novice investors or new to the precious metal sector, they don't really, they look at, the coin demand from the U.S. Mint and places like that, and that's not really the market that drives the price of gold and silver. That drives the physical market. I mean, and I don't know what it's going to be after this latest, the latest few weeks, where all of a sudden there's been this skyrocketing demand for physical or for silver eagles, but et cetera, silver bullion coins. But up until recently, retail investor demand for silver, like mint products and Royal Canadian Mint products, was about 4 to 5% of the total consumption of silver produced on an annual basis. So, and gold, it's even smaller. So, gold is kind of the big boy market, because it's, there's a reason why silver's always been known as poor man's gold, and they both serve the same purpose. Silver's actually, dual purpose, because it has industrial applications. A lot of that silver gets recycled, but it still adds a layer of scarcity to silver that gold doesn't have. But in terms of, so what I try to look at and stay on top of is what's going on in the big boy market. That'd be the sovereign market, the central bank market, super wealthy families, trusts, individuals, that type of thing. And the latter is kind of hard to track, but there's a precious metals report that I get for our fund, and the guy John Brimlow publishes it. He comes out with updates 3 or 4 times a day, and he covers the global bullion market. I mean, he dredges up data from India, Vietnam, Turkey, China, and a few other Eastern Hemisphere countries, as well as covering what goes on the LBMA, the London Fix, and the COMEX. And so the way to measure demand from China is you look at what the market price is over there, over and above the cost of importing gold, which would be the sort of the global cost of gold, the spot price of gold, Plus there's a import duty that gets tacked on, when gold goes into India. That's why part of the reason why there's such a high amount of gold smuggled into India, which no one can really track. But so what happens is typically coin or gold distributors over there, they won't import unless they know they can get paid a certain dollar price over and above the cost of the gold plus the import duty. And so when that premium, the ex duty import premium, is high enough, then there's a lot of gold going into China, and that's kilo bars, which would be more expensive, and then just doré bars, which would be gold bars that are sourced directly from mines, and then imported into India. They have a lower import duty, but then they get imported into India and then refined into the kilo bars, which is what the Indian public prefers. So that premium had been negative for quite a while. And then I think around September or October, all of a sudden it started popping up, and all of a sudden it was like, whoa, the premium, the ex-duty import premium was really high, and it's been really high for several months now. And that's an indication that, the Indians are importing gold hand over fist. And again, it doesn't account for the amount of gold that's smuggled, but even the entities that track imports into India have had to admit that the amount of gold going into India is enormous right now, like the World Gold Council. China is somewhat similar. I mean, there's a premium to spot that gets published by the Shanghai Gold Exchange every day, and that's when it goes positive, it's an indicator that there's a lot of demand for gold over in India. Since last February, it had been negative up until, which meant there's not much going on in terms of investment demand over there, and until about, I don't know, 3 or 4 weeks ago, and all of a sudden it's turned positive. The problem with trying to assess what's really going on in China is that the government itself doesn't publish gold import statistics, or silver for that matter. So the only way that you can somewhat track what's going into China is from the export numbers into China published in Hong Kong. However, China also, the most recent port was in 2014. They opened Beijing for imports, and they also opened up Shanghai and I don't know, Shenzhen. That's the other port of importation for gold. But the article that I had read, and this was in 2014, and it was from the South China Morning Post, and it basically said, China opens Beijing to gold imports, cutting Hong Kong's transit role, and the motivation for opening Beijing was to help the PBOC keep its purchases discreet, as the article referred to it. So, for strategic reasons, China doesn't want the world to be able to assess accurately just how much gold is being hoovered up by official gold by the government / PBOC. If you just look at investment demand over in China, it's certainly picked up again in the last several weeks versus, what it had been since February. India has been, full bore. And what's amazing about India is usually, we had a pretty big move recently in gold, and it bounced in early January before it got hit again. India usually, like, if you get 20, 30-day dollar up days in gold, all of a sudden that ex-duty import premium goes negative or flat. The Indian public is very sensitive to, price. And historically, when the price has moved higher, they've stopped buying for a while until they get used to the price and realize they're not going to be able to, they might not be able to source it. The price might not go down. But when we've had the rallies in gold recently, the buying hasn't slowed down, which is amazing to me. And then now you layer onto that, what's happened recently with the retail silver demand. And I mean, no one really knows for sure, because it's by intent. What goes on in the physical gold and silver market is intentionally opaque as possible, and it's kept that way by, you know, governments and central banks. But it certainly feels like there's, you know, a potential, at least at the current price levels, potential shortage of physical gold and silver developing right now. And I think we saw signs of that in March, when, you know, based on, you know, the monkey business going on between the LBMA and the COMEX, they clearly, there was a period there where they didn't have enough bars to deliver into people who were demanding them under derivative obligations.
And physical silver has become a lot more popular in India for the last 15 or so years. Talking with my friend I went to business school with in the MBA classes, who's Indian, silver became a lot more popular for dowries, whereas in the past, dowries used to be mostly gold, and then it switched to more of a silver gold mix. So silver has become increasingly popular, and over the last, I don't know, 6 or 7 years, there's been good amounts of spikes of tonnage of physical silver going into India. But India ran a record trade surplus in 2020. So it would make sense, Dave, that the private companies in India would, or private, more affluent people would reinvest some of their trade surpluses or profits there into metal as savings.
Yeah, no question about it. And the agrarian economy, the farmers over there, whenever there's you know, when they're, you know, after they harvest their crops, sell them, you know, and set aside money for living expenses, whatever's left over, it goes right into gold. And this year was a pretty robust year in terms of the monsoon season, and the you know, the crop yields over there. And so that's part of what's driving it. I mean, that's part of the reason, that's part of what drives the cyclical demand over in India, or the seasonal demand over in India, is the harvest season, but also obviously the festival and wedding seasons.
I think the paper gold price in dollars is very correlated now to the growth in the Fed's balance sheet. So do you think then, if the Fed's balance sheet goes to 8 trillion, 9 trillion, 10 trillion, and probably off balance sheet, it's already there, but on balance sheet, like a lot of people believe the 7.4 trillion number. Do you think then that the gold price will take off in the next 6 months if the Fed's balance sheet then starts to go a lot higher?
Yeah, I mean, I don't think there's any question that the Fed's going to have to take its balance sheet higher, and the government's going to incur even higher deficit spending. I mean, the stimulus programs alone that they're talking about putting into place. I mean, I think they're already they haven't even passed the current one, and I think they're already talking about another one after that. So,
well, they already have all these rules about that people can't get them. So they're changing all the rules, and most of the bailout money is going to the states and local governments and then to corporations. So it's going to special interests. It's not going to the people who claim to have voted for it in the congressional election and the presidential election, who thought they were going to get a check. Now there's like, oh, you make too much income, now you're not going to get a check, even though people probably voted for a politician thinking that they would.
well, I don't think, if you have enough income to support yourself and your family, I don't think you should get a stimulus check. You know, and you know, a lot of people who didn't need stimulus checks got them. I know several. I don't have a problem with that, but
Yeah, they
it's
sent me. Did you get a $600 debit card? They just sent me it. It looks like a scam.
I didn't get a stimulus payment in the last go around, and
Yeah, I haven't activated it. It honestly looks fake. I was reading articles about it, saying it's not fake, but it does. It looks like a scam.
yeah, you know, that is what it is. I mean, what's appalling is how much of the money that was printed up and how much of the money that was doled out by the federal government went to corporations and banks, and, you know, bailing out the airlines. That to me was the most appalling, and that accounts for most of the increase in debt and money printed since March.
Yeah, Congress mostly just panicked and passed the CARES Act when the stock market crashed. So it was about the propping up asset prices, stocks, bonds, real estate. That's what the government cares about mostly now.
Well, if they don't prop it up, it's going to collapse.
Well,
It will
they need
anyway.
those.
It's just, is it going to, would it collapse right now if they stop propping it up, or can they keep printing money and incurring treasury debt and treasury obligations to defer the inevitable a little bit longer?
Well, the other thing is, if you look at a chart of how much of the annual US federal government tax revenues are from capital gains taxes for stocks, bonds, real estate, over the last 20 years, the change is dramatic. So the amount of capital gains tax revenues that the Treasury requires is enormous compared to the past.
Oh yeah, no question about it. And there's a reason why, a lot of this money is going to go to the state and local governments. I mean, the state and local governments are on the brink. A lot of them are.
So I want to ask you a couple questions on gold producers versus juniors before I let you go and we wrap up this interview. You said you want to keep a little short. That's fine. So over the last 12 months, give or take, junior mining stock ETFs have outperformed gold producers. And when I look at the financial statements of a lot of these gold producers like Newmont Mining and others, they have $800 or $900 an ounce profit margins, enormous free cash flow. Their net debt is down to record levels. These are good businesses now. And 2.5% give or take dividend yield, getting paid to wait for a higher gold price. So why do you think then that the junior mining stock ETFs have outperformed a sound gold mining producer like Newmont Mining and some of the others?
Well, I probably take issue with the idea that Newmont and Barrick are sound, but they've got problems trying to replace their reserves with the amount that they deplete every year. So that's just part of the problems. But certainly, that those stocks have done well, and the companies are now generating a lot of free cash. I like Agnico better than Barrick or Newmont. I think Agnico is probably the best run of the really large mining companies, and its stock has outperformed Barrick and Newmont since March, I believe. Certainly certainly over the last 52 weeks. But in terms of the juniors, I mean, I guess kind of the easiest way to think about it is, if you look at a junior mining an exploration company that has, a bona fide resource estimate. So it potentially has gold or silver in the ground that eventually can be turned into an economic deposit and can be mined successfully. There's a lot of variables that go into that. But, a lot of these juniors with a bona fide resource estimate, say, let's just take gold, for instance, the market cap of the stock itself is valuing the resource, the identified resource, at maybe say $10 or $20 an ounce in the ground, right? And that's and again, there's a lot of capital and time that goes into getting a resource advanced to an operating mine. But if you can do that, all of a sudden you're producing, at least using today's, sort of generic statistics, you're going to be able to produce, an ounce of gold that, originally the company was being valued at $20 an ounce in the ground. All of a sudden that gold is worth, or 800 to 1,000 an ounce as a producing mine, right? So that's just enormous leverage to the price of gold. And there's enormous risk also, but
yeah, they're kind of like call options. Yeah.
Well, that's the thing. I mean, you look at a 50-cent junior gold explorer, and it's essentially a far out of the money call option on gold, on the price of gold, that and it doesn't really have an expiration date like a standard exchange traded call option does, right? And so that's,
as long as the junior can raise money, right?
Yeah, and we're in an environment now where most juniors with credible stories don't have any problem at all raising money. But and that's part of what pushes the value of these things up, because that capital raising is one of the key risk ingredients to these things. But it's the way these juniors work is when the price of gold is rising, and the market has, you know, a bullish sentiment attached to it, then an out of the money call option is going to outperform the underlying stock, right? So let's just take a XYZ uh, Nevada gold explorer that has a resource in the ground. Eventually, at some point, Barrick or Newmont or the Barrick Newmont joint venture is probably going to take it over. And if not one of those three entities, then a mid cap producer looking to expand its mining portfolio and expand its resource inventory is going to take it over. Or you might have one of the other non-Newmont, non-Barrick large cap companies. There's global companies that are looking to diversify their mine portfolio into North America for a lot of reasons, a lot of good reasons. So when the price of gold is rising, the market's bullish, all of a sudden the option premium of these junior mining stocks balloons up, and then it's vice versa when the price goes down. So one of my Mining Stock Journal subscribers asked me about Eli Gold Royalties yesterday. He's like, hey man, it's underperforming a lot of my juniors, and it's certainly underperforming the large royalty companies. And I'm like, well, bingo, you just answered your own question. Why? Because Eli Gold Royalties it only has a couple of royalties that are current pay. It's that within the next year or two, it'll have a few more royalties that are current pay, and then it has some royalties that are 3, 4, 5 years away from paying off, but they could be absolute grand slam home run royalties. And so when the price of gold is rising, Eli Gold Royalties is going to outperform the large royalty companies like Franco-Nevada or Royal Gold, and vice versa. When the price goes down, it's going to underperform them. So
doesn't Eric Sprott have a large position in Eli Gold?
He does, and I forget what the exact percentage is. I don't think it's, I don't know, somewhere between 15 and 20%, I think.
Yeah, normally he likes to buy at least 10% of a junior.
Yeah, it kind of varies, I think, but certainly, if he feels very strongly about certain companies, he'll take a big position in it. Eli's certainly one of them in terms percentage wise. I mean, at this stage, for a guy like him who's got the bankroll he's got, buying 20% of Eli is, or 15%, whatever it is, I forget off the top of my head, but that's like you and I going out and buying a Big Mac from McDonald's.
So I know you've been in the gold industry even longer than I have, and I've been in over a decade. What are some red flags that you, speaking with management teams of these junior miners, and I know you've been to conferences, you've interviewed them, you've grilled them over the phone many, many times. You and me have talked about this in past interviews. What are some of the red flags that you look for on your investment due diligence checklist to avoid for listeners out there that are like obvious red flags for some juniors that you will not put any capital into a junior then if you see some of these red flags?
I mean, for me, the first one is how highly, to what extent is the company being heavily promoted by what I consider to be shady promoters. And I don't want to discuss any specific names, and there's certain promoters that I think are somewhat unscrupulous. But there's a lot of things. To what extent, one of the first things I look at when I'm looking at a new idea for a junior is, and this isn't, it's not necessarily a strike against the company, but I want to see how many shares has it issued over the history of the company, and what has it done with the money from all that share issuance. I mean, some of these junior mining companies they're just serial share issuers, especially when the market gets hot, and then they go and they piss away the money, and they don't have anything, and then all of a sudden they're on to the next project. So these juniors that kind of go from project to project to project, and all they do is issue shares, that for me, I won't go near that. I stop looking at the company.
Yeah, I agree. Or they do reverse stock splits, or they change the company name, they change the business model. They go from like Brazilian gold to copper to some other type of project. So it's back and forth, and it gets very confusing. And some of these companies are very heavily marketed with podcasts and YouTube channels and at conferences.
Yeah, you know, for me, it's easier in terms of like, you know, what types of red flags to look for, you know, as opposed to that, I kind of have a certain checklist that, you know, I try to adhere to as much as possible. And, you know, one of the things is if I'm looking at a, you know, a brand new junior company, I want to see who the management is, what their track record is. I want, you know, I take into account where the project is. You know, is it in an area where that's known for, you know, prolific gold and silver production, either historically or currently. You know, I want to, so in other words, I want to try and, you know, look at the DNA of where the project is, the DNA of the geology where the project is. You know, I look at jurisdictions. I used to not worry about jurisdictional risk in the first 10 years that I was doing this. And, you know, in the last 10 years, I've been bitten in the butt a few times by jurisdictional risk. And so
Well,
I scrutinize that a lot more closely.
These politicians and bureaucrats, they were always changing the rules. Like they put an extra royalty on Fosterville in Australia. That's the highest grade gold mine in the world, the one in Australia that the Kirkland Lake, Kirkland Lake gold runs.
Kirkland Lake, yeah. Oh, I didn't know that. That's good to know.
That was a couple of years ago. Yeah, they stuck an extra royalty in there. Oh, hey, you're making a lot of money. Oh, we want an extra 20 or 30 million in a royalty per year.
And that something like that doesn't bother me per se. You know, if you're a company, especially a foreign company, going into a foreign country and you're exploiting their resources, yeah, I mean, I think, you know, there should be a tolling fee for the government, you know, as long as the government spends it wisely, which probably won't happen, but
well, it depends if the mining company is reinvesting prudently back into the local community. They're hiring locals for jobs. So I think that's all part of it. Because then, like, if the mining company is doing that and they're being good stewards of investing in the local community for infrastructure, roads, schools, they're being environmentally responsible, and then the government is just ignoring that and taxing them, I think that's ridiculous.
yeah, well, no question about it. But you know, again, that's why I tend to focus more on the junior explorers, because if they develop a viable project, and once it gets acquired, it's the acquiring company's problem, and I'm probably not invested in the acquiring company. So,
Yeah, that makes total sense. I think you do an excellent job picking out juniors. So for listeners out there, and I get messages all the time on my Patreon and comments asking about juniors, Dave spends way more of his time interviewing junior mining CEOs than I do. So I do look at companies like Silvercrest Metals after they already have a resource, but Dave found Silvercrest Metals when it was way below $1. Dave, can you just tell that story as we wrap it up about how you found Silvercrest Metals, how cheap, and the type of gains you've gotten? Because that's unbelievable, the returns you got on that junior.
what became Silvercrest Metals was originally part of Silvercrest Mines. So Silvercrest Mines had the Santa Elena mine, and then they had a bunch of land, a bunch of mining claims, kind of near Santa Elena, and one of them was the Las Chispas property, and what became the Las Chispas project. And so I knew of that project when Silvercrest Mines was still independent. When First Majestic acquired Silvercrest Mines, I told my guy there, I'm like, well, what are you guys doing with Las Chispas? He said, oh, well, we're gonna spin that off into a private company that, you know, the management that's not going over to First Majestic will develop, you know, the Las Chispas project. And I said, well, as soon as you guys go public, give me a call because I want in on it. And I think it was early January or maybe December of 2015. Spoke to the guy. His name was Michael Rapps, really good guy. And he said, well, we just went public and we'll have, and I don't I don't bother with the Toronto Stock Exchange, not because I don't care for it, but it's just it's a little bit more of a headache that I don't need. So um, I need the company to have shares that are listed at least on the OTC bulletin board here. The 5-letter symbol shares. So once that was up and trading, and that was early January of 2016. It was around 16 cents when I got into it, and it was actually right before I had rolled out the mining stock journal. I rolled out the mining stock journal in March that year, but I had the short sellers journal, which I had rolled out in December 2015, and so I presented it as an idea in the mid-January issue as a contra NYSE play, right? So sort of as a investing in gold and silver is in a way, a contra stock market play. I just wanted an excuse to get it out there, give my subscribers an idea that I thought would make a lot of money and be on record that, hey, I jumped on this idea at 16 cents. So that's kind of the history of that. And I think it's traded as high as, fast forward 5 years later, and Silvercrest Metals closed at 990 today. So, and it's been, I think, as high as 12 or 13 recently.
That's generational wealth right there, depending upon how much someone speculated in that stock.
We had a big position in it in my fund. That's for sure. I pared it way down, and we still have a position in it, and I still like the company. And I think it's just not the type of home run that I look for at this point, but it's a good, I call it sort of a good core holding in any junior mining stock portfolio, because, eventually one of the large silver mining companies will take it over. Just real quickly to circle back to another red flag, because we're speaking of silver now that I think about it, and I was actually just talking about this with a officer at one of the mining stocks that we own. It happens to be a silver junior explorer, and we were just talking about this, about the quality of resource reporting, and we were both like, one of the things that just drives me crazy is these silver juniors that they'll report a silver equivalent, assays or silver equivalent resource estimate. And a lot with some of them, it turns out silver might only be 40% of the mineralization or the resource, and the rest of it is the equivalent part is, typically lead, zinc, or copper in the resource. And so, there's a handful of silver juniors that market themselves as silver companies when in fact they're really base metal. They're basically base metal projects. So that for me is often a red flag.
And a lot of potential new silver mines, they're going to need a much higher silver price of $35, $40 an ounce for them to be economic. So with the exception of Mag Silver's Juanicipio mine and then Las Chispas, there are very few other potential new silver mines that are economic at a lower silver price. So all the new potential silver mines in the not too distant future, they're going to need a much higher silver price in the next couple of years, probably 5 years or less.
I would agree with that, except for, the Cordero project at Discovery Metals. That was another one that was a grand slam home run for me. I was recommending Discovery Metals at around 20 cents, and now I don't even watch it every day, but closed at $1.76 today, and I had it at 20 cents September 2019, I believe.
So over an 8-bagger. Impressive.
Well, I think there's still, considerable amount of upside left in this one. It already reflects the expectation that Cordero is going to be a massive silver and base metal mine eventually. But they have other projects also that they can advance to add value.
So if the listeners have not figured out, Dave really does his homework on this, and he does grill the CEOs and the executives. They get very tough questions. He is not buddy with a lot of these guys. He asks them, maybe later on he's buddy, but they get asked very tough questions about their projects, about if they're buy and hold their shares. He asks them very tough questions about these things. So I highly recommend Dave's newsletter. He's had a lot of success over the last 10 or 15 years speculating on junior miners for him personally and his gold fund, and then also recently with his junior mining stock newsletter.
Well, thanks, Jason. I appreciate that.
Well, I've interviewed a lot of newsletter writers, Dave, and a lot of them do not do the due diligence that you do. Let's just put it that way.
I can't speak for other newsletter writers, but yeah, I enjoy doing research.
Oh, I have some really horrible off the record stories that I can't say publicly. There's some of them are bad. Some of the newsletter writers, let's just say, I would never buy anything they recommend. That's all I'm going to say. Some of them. So I want to thank you again for your time today, Dave. Got a lot of good insights about the bond market, your bond trading, the technology bubble, and also junior mining stocks. So thank you very much. And if my listeners want to check out your newsletters, how did they do so?
Well, my website's investmentresearchdynamics.com, and at the top there's two links where you can find out more information about the newsletters and the cost and things like that.
Great. Well, thank you again for your time. I appreciate it.
Thanks, Jason.
Please share the video with friends and family, and don't forget to subscribe to the Wall Street for Main Street YouTube channel, which just crossed over 40,000 YouTube channel subscribers, finally, after many years of YouTube censorship. The YouTube censorship is getting so bad now that longtime subscribers to my channel, and I'm getting emails and messages and comments below videos and Patreon messages that people are not getting new videos in their feeds anymore who have subscribed to the channel for many, many years. So please check the channel manually to make sure that you're getting all the new videos. And I'm trying to put out more despite the long list of health problems, debilitating health problems that I'm dealing with. And also, if you can afford to do so, please chip in $5 or more per month over on my Patreon. And unfortunately, the links to my Patreon are now being blocked by YouTube, both in the links after videos. I've been checking them. They normally don't work now, unfortunately. Occasionally they do work, but most of the time for a month now, they have not been working at all either. So YouTube censorship is getting absolutely ridiculous to make sure that I struggle to pay my bills. And as an added benefit for being a patron, not only will you help me pay my bills so I can continue to put out research, content, information, analysis, and financial education with these videos, and I'm going to be doing more and more interviews with experts. I've sent out emails to a lot of big name guests. I won't name the names yet, but I'm trying really hard to get some big name guests that I've never had on before, but also articles unique for patrons behind the paywall there. And there's over 150 articles on many different topics, including precious metal royalty and streaming companies, gold miners, silver miners, oil companies, uranium miners, and other commodity-related investments. So that's something you don't want to miss. I think it's a really good value, and I'm doing the best I can to create value in terms of the videos and research and analysis, despite my long list of debilitating health problems that are very difficult for me to do any work. But I'm doing the best I can, and I'm going to keep growing this YouTube channel, hopefully in spite of YouTube censorship, and hopefully I will be able to continue to create value and grow the channel much larger in the not too distant future.